bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people want to make friends. I'm just trying to make you money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC. Or, of course, tweet me at Jim Cramer. Tonight, I'm letting you in on something real big. The method of my madness. Come on, I know this is the craziest, most random, and frankly bizarre thing on not just business TV, but television in general. I mean, think about it. A one-man show about business? But I also know that you won't find investing advice this good anywhere else. You know that, too. Or else you wouldn't be watching. Unless you're one of those people who tunes in just to see if tonight's the night that I actually do go off the rails, which after multiple years of airing is always a possibility on any given night. Sorry, guys, there's a tape delay, but keep wishing. Bound to happen one day, although I do my best so it doesn't. This show is all about the method or methods to break from strictly quoting the Bard to my madness. How do I pick stocks? What gets on this show? You always ask me that. Why do I tell you that some stocks are worth buying now or on a dip instead of just like, hey, you know what, tomorrow? That's the question that everybody would like to know. So tonight I'm going to give you pieces of the answer. Let's get rolling. One of the easiest ways I identify potential Cramer names for Mad Money, the stocks that could but won't necessarily always end up on the show, is by watching my favorite list from when I was, frankly, a little boy in 5th grade. I used to look at the new high list. I thought it was like the guys who were hitting better than 300 in baseball. Stocks on that illustrious list, the highest of the high, obviously has something going for them, and that's especially true when the market's in bad shape, as only the best of the best can hit new highs when the market's falling apart. So what's it tell you when a stock hits the new high? Either that it's part of a genuine bull market, or the company itself has some serious earnings or sales momentum, or maybe its sector does, which is so often responsible for a stock's increase. No matter how they get there, many stocks on the new high list often keep going higher because it's really a list of A students that are worth investing in. The A students tend to repeat themselves in the process every quarter, just like the really smart kids in school. In a great bull market like we've had from the bottom in 2009, and any market, by the way, that doubles from the bottom has to be considered a great bull market. Even as I know so many resist such labels, we saw this new high list phenomena over and over again. The same stock would hit new high after new high after new high, and following them was a great way to make money, even as the bears claimed endlessly that the bull market was false and couldn't be trusted. Listening to the bears caused you to miss out on one of the greatest rallies in history. Now, obviously, the rally since the bottom is more like the exception than the rule over time of all the years I've followed the will continue to work. Because these stocks typically represent companies that are best of breed. Always remember that phrase because it's integral to Mad Money. I'm not saying that just so you can chase stocks that are hitting their new highs because they'll keep going higher. That would be the ultimate foolishness. True bozo the clown behavior when I used to have hair. I'm saying that if you want to identify stocks that will be winners in the future, unless there's been a big sea change in the market caused by maybe a gigantic political shift or a radical shift dramatically higher in interest rates, looking at the biggest winners of the present is a pretty good place to try to figure out the future. Let this list do it for you. It's already been scrutinized and scrubbed. That's the thing about the market. It's not always that hard to play once you understand that there's often more continuity than change. Things pretty much keep going the way they're going until something major shifts. And then you do have to alter course. Those course changes can be pretty radical, though, and that's why you always have to be reevaluating your ideas and should never dig in your heels when the facts change. Something we emphasize over and over here, and it also infuses my columns in Real Money and all of my books I've written, save my autobiography, Confessions of a Street Addict, which is more of a score-settling tome, settling scores with myself, of course. Hey, it isn't called Mad Money for nothing. But you know what? When you're looking for stocks to invest in, when you're hunting for the bull market like I always do here, looking at the new high list is a terrific way to begin. Now, I don't just pluck names off the high list because I think, hey, these stocks have gone up, so they're going to keep going up. That's a little lazy and irresponsible. I have many things, a lot of them negative. But lazy and irresponsible, I don't know. Anyone who sees my insane tweets at 504 at Jim Cramer, that's right, at Jim Cramer, knows, yes, that is me tweeting. Some people say, hey, is that someone else tweeting for you? Who else would get up at that early? I mean, you can't do that. I mean, and then, of course, the obligatory, do you ever sleep? I mean, well, no. I mean, at least not for any long stretch. I apply the same standards, though, of rigor to this show that I used at my old hedge fund. So I rarely recommend buying stocks straight off the new high list unless there's some special circumstances. I'll talk about those later in the Tonight Show. What I do like to do, though, when I'm hunting for stocks, and what you need to do, is wait for the fabled pullback from the new high list, because that is the best place to put money. The pullback, and there I'm thinking about something that could be 2 or 3, preferably 5%. That gives you a good lower price entry on something that's on that list. Remember, I am not telling you to chase momentum. You should always be conscious of price and therefore try to buy on weakness, just like you want to sell into strength. Most people can't pull the trigger when a stock's going down because they think something wrong. I'm telling you, if it's on the new high list, comes down, they'd be your man. I'm throwing these caveats in, though, because I don't want you to look at the new high list as your shopping list. Big mistake. It's a jumping off point one, albeit a very important one for those who are trying to get started. Pouring over the new high list is a fabulous way to identify potential, and I stress that word. It's potential stocks to buy. You only buy stocks that have pulled back from the new high list if you're confident they'll make a comeback for substantive reasons having nothing to do with the market. You have to do all the same homework you ordinarily do before buying a stock. It's not, you don't get a pass there. You absolutely must have conviction, even if it's a cynical conviction that this stock is going higher. And I do that for a lot of the IPOs that I go crazy about, where I'm really saying, listen, cynically, I know the buyers go crazy about it. Me, I accept that they're just pieces of paper. Meaning, you know the big boys can't resist growth stocks, right? And they will always come to the support on down days. And the biggest caveat of all when you're shopping for stocks that have pulled back from their new highs, make sure they haven't pulled back for a good reason, that the sell-off is extraneous to their business. Don't go buying a home builder that's down if interest rates flew up because they could at least initially get hurt with the quarter. Hey, by the way, don't buy a big independent oil stock when oil goes down for 3 straight days, because that probably doesn't belong in the new high list anymore. I always like to say that you're looking for a stock that has Bristol-Myers-like strength, because almost nothing has to do with Bristol-Myers. Be certain you're dealing with a momentarily damaged stock and not a troubled company that's going down, down, and down. How do you tell the difference? Another key part of my philosophy. If the fundamentals haven't changed, the stock probably hasn't fallen from grace. It's pulled back for largely mechanical reasons, profit taking or some panic in the market in general. Now more than ever, thanks to the fact that stocks are traded like commodities by ultra-levered hedge funds, causing huge sell-offs that make no sense in everything, or double and triple related ETFs that are more powerful than the stocks themselves. Well, you see the stocks of good companies pull back from their highs for nothing that happened to do at the company. Nothing to do with the company or the strength of the underlying businesses. Those are the buys. Buy! But if the fundamental picture changes, if whatever made the stock attractive as it climbed its way up to the new high list goes away, then that stock is no longer a candidate. Sell. The story has to be intact, or this method will let you down. While it isn't a hard and fast rule, I tend to like stocks that have pulled back, just enough, but not too much. All right. I have to tell you, 8% is the historical optimal level of a pullback that I've really made a lot of money in. Less than that, you know what? You're going to be early for some of them. More than that, and maybe something is indeed wrong with the stock. You just don't know. 3, 5, 8. Those are all important levels. That 8% level, man, I've made a killing when I buy them down 8. Bottom line. That's the first method of Cramer's madness. Watch for stocks that have pulled back from the new high list, especially because of a broad market sell-off. Some of my best picks have come out of this process. It's my getting to work shopping list. Hopefully some of yours can too. Why don't we start with Arzella in Ohio? Arzella.
Hi, Jim, and booyah to you.
Booyah right back.
I'm trying to get a better insight on mutual funds, and I'd like to know, are they a good way to diversify?
Well, you know what, Elmer? I got to tell you, Arzella, here's the problem. A lot of people have 401ks where you have to have mutual funds. And you can't pick individual stocks. And for that, they are. And what I like to do is have, say, 20% international, 50 from, I'm a little bit older, 50% growth. The rest will be kind of a balanced situation, maybe a fund that has some bonds. You have to depend on your outlook and your age. But yes, mutual funds are fine. Try to look at some of the performance records in Morningstar. That's what I use. Glenn in Louisiana. Glenn.
How you doing, little man?
What's up?
Nothing. I'm asking you today for some simple advice. I'm 65. I'm retired, and I'm needing to keep my portfolio directed towards yield and a little bit of growth.
Okay.
I'm fairly diversified, but I'm kind of afraid of what the market's doing in and out, in and out. Mm-hmm. So, and I'm trying to be goal-oriented, but I need your advice on how to be more diversified and with less risk.
Well, I think that the telcos, the telephone utility companies, the traditional electrical generation companies, the IYR stocks that are yielding more than 4%, those are a lot of the real estate investment trusts. And then the master limited partnerships, not all if it's in an IRA. There's some tax considerations. But those are the areas I look, and they've been quite, let's just say, consistent in generating good returns in good and bad times. Stuart in Florida. Stuart.
Jim, what's the best time to use stop orders after you purchase a position?
No, we're not going to do that because, you see, if we're going to trade actively, we're going to have to pay attention to it. And if we're not going to trade, we're going to invest. We don't need stop orders because what could happen? The market could be down 10% in a flash day. You'll have sold the stock, and then it bounces right back, and you'll say, what the heck happened? We don't play it that way. We invest in mad money. We're not traders. We invest. All right, there's a method to this madness, and tonight I'm revealing it all. The first method, look for stocks that have pulled back from new highs, especially because of a broader market sell-off having nothing to do with the individual stock that you want to pull the trigger on. Stay with Cramer. Welcome back to tonight's Methods to Madness special, where I'm revealing some of my best tricks for buying and selling stocks. Truly timeless investing wisdom for the ages, I hope. Next up, how do you find stocks that are great buys? Earlier, I was talking about picking off stocks that have pulled back from the new high list because you get a cheaper entry point in a stock that's been a proven winner. I said you didn't necessarily want to buy names right off the new high list because you're paying too much for them. You can usually get a better deal if you're patient and wait for some weakness, maybe down 5-7%. Given how volatile and downright crazy the market's become, there are very few occasions when buying a stock right off the new high list or that close to it is justified. But sometimes the stock is so hot, they just got to buy it whenever you can, as soon as you can, because it may not be going lower anytime soon. You won't find these often, but when you find them, you have to remember not to buy all at once. If you want to buy 100 shares of stock, you think it's got so much mojo that it won't get a pullback from the high, then go ahead and buy 25 shares. Worst that happens, it goes higher, you don't get to buy more, and you grab a quick profit. And find another stock. Believe me, there is always another stock to find. Now, I've got an exception where it's okay to buy a stock right around its high. If you see insiders buying the stock when stock's up a lot already, I'm going to give you a total buy green light. Now, it is a rare thing to see happen, but in my experience, it's rare still that this method of picking stocks doesn't work out. See, I love it when insiders buy after a decent run, because that's a great sign of confidence that they think the run's just beginning or there's a big runway ahead, and they are sure that it's long-lasting. Remember, you can't flip a stock immediately if you're an insider buyer. You have to wait 6 months. Government takes away the gains otherwise. It's the law. So these people are seeing things that they like that aren't going to disappear in 6 months' time. If anything, they haven't appeared yet. Normally, insider buying ranges from being meaningless to a small but on its own insufficient reason to buy a stock. A lot of times you're going to catch insiders buying their stock. They want to give the impression of confidence, create an illusion they're doing better than they really are. Insiders aren't stupid. They know if they're seen buying their own stocks, even small amounts, then the market will smile upon them. So they play the system. Hey, that's fair. But it means we ignore most tiny insider buying because, well, it could be kind of flim-flam. What a word. We used to also call it painting the tape. Kind of makes it look better than it is. That said, when you get truly colossal insider buy, even if it's not at the high, you might want to take another look at the stock in question because it's a pretty powerful endorsement when the insiders buy a whole lot of stock. It's really the volume of the insider buying that declares its sincerity, but we're only focusing on one sort of insider buying right now, stocks that have been running and aren't perceived as being historically cheap or low dollar amount plays. These aren't value stocks. There's nothing more arrogant and yet telling than when an insider backs up the truck for his own stock when it's been rolling along at a pretty good clip. They're saying, yeah, we know we rock. Our stock's been in fuego. And we're so darn confident, well, that it'll keep going higher, that we're going to buy some shares hand over fist right now. We're not waiting for a pullback. Nope. We're buying right here. Arrogant, sure, but this is bankable hubris. I've seen it time and again. Corporate insiders aren't fools, with some notable exceptions occupying, of course, the mad money wall of shame. And hey, if their stocks are on a tear, well, let's assume if they're buying, they probably do know something. Not everyone deserves the benefit of the doubt in this business. And after the financial crisis and the market meltdown at the end of 2008, I know that a lot of people think that all CEOs and executives, for that matter, are a bunch of crooks, frauds, and that everyone should be and mount banks, especially those who got burned owning the old, say, Fannie Mae or Lehman Brothers. But look, that's the wrong lesson to draw from the crash. Healthy skepticism is one thing. A total unwillingness to believe in anything positive is something else entirely. If you're going to own stocks, you need to be willing to extend some measure of trust to the people who run the companies that you own shares of. What else could be going on to spur buying? We've had a massive amount of consolidation in a host of industries of late. We've seen it in airlines, rental cars, foods, telecommunications, entertainment. Perhaps these executives are buying stock because they hear the footsteps. Maybe they've been contacted by some other company and turned that company down. Spurred overtures happen all the time. And if executives expect that they may be next, well, it could be a healthy and honest reason to buy. Of course, they have to disclose anything that's a serious bid. But a lot of times you can just get a phone call and say no, buy. Well, they do that because the company's worth more than they thought. Maybe they think the company could be broken up, like the old Tyco or Fortune Brands or Gannett. Maybe they see the ability to create value and they just want in on it themselves. Or maybe the stocks run just a bit, but they don't think the run is over because they recognize how much better the company will be when it's divvied up. Well, for us, buying after big runs can be a bit reckless and lazy. Most investors are smart enough to wait for a pullback before they pull the trigger. Insider buying after decent runs tells me that these guys don't think there will be a pullback. And there's nothing more bullish than that. Sure, I want to wait for a pullback after they bought, but that's the best of all possible worlds, and you usually don't get that best of all possible worlds scenario. Bottom line, one more method of Cramer's madness. When you see insider buying in a stock that's already had a solid run, well, you probably want to be buying too. Bob in New York. Bob.
Jim, Steeler booyah to you.
Steelers from New York. All right, well, why not? What's up?
Jim, I have a question about interest rates. When the Fed raises interest rates, good companies with attractive dividend yields and growth prospects suddenly rapidly go out of favor. Can you add some clarity to why?
Well, because people extrapolate there, Bob. But once they see rates go up, they just fear they're going to go up for a while. If that's the case, they want to get out of what they perceive as being a risky yield, which is a stock yield, and go into what's a certainty, which is a bond yield. So it's all relative basis. Rick in California. Rick.
Booyah, Jim.
Booyah, Rick.
How do I add to a position if my stock hasn't gone down to the average list price?
No, you can't. I'd say the vast majority, not just a few times, not just the majority, but the vast majority of times we pay up above our basis. Well, I got to tell you. Sell. You got the picture. Remember, here's another method by madness. When you see insider buying in a stock that's already had a big run, think to yourself, I might want to be buying here too. After the break, I'll try to make even more money. You're in luck because you caught Cramer on a good night. I'm not going home to sip that cheap scotch on my dirty linoleum floor. And by the way, I got to apologize to Doers, which I once suggested was the linoleum floor scotch of choice. It's actually pretty good stuff, especially the boutique 18-year-old. Have you had any of the 18-year-old Jamesons? Never mind. Okay, look. Don't waste that one on the dirty linoleum floor. No. Tonight, obviously, I'm in a great mood. Maybe a manic mood even, which is me at my absolute best. Because, well, let's just say I'm pretty darn productive and present when I am in high gear. So, naked. So, revved that I'm revealing many of my secrets, the methods to my madness. All right, so pull out your pencil and some paper. Yeah, I haven't used that line in a while. Start jotting some things down because I got to tell you something that could be incredibly useful. Better than giving you some stock picks, I'm giving you some of the best ways I know to pick stocks. I'm teaching you how to invest and trade like Cramer. If not to be like me, because I got some kind of like emotional things cooking here, but at least emulate me. I mean, you know? All right, so far I've given away 2 of my precious secrets, 2 of the tools that I used at my hedge fund, still used for my charitable trust, ActionAlertsPlus.com, where I play with an open hand, allowing subscribers to see all my trades before they happen. I look for stocks that have pulled back from the new high list. That's not a reason to buy in itself, but it's a great place to look for potential buys. And I like to buy stocks that have had big runs and yet still have substantial insider buying because it says the people running the company really believe their stock has legs. And if they believe, could be a good reason for us to believe too. But again, this alone, not enough to recommend a stock. You still need to do the homework, to check the fundamentals, to make sure you like the story behind the company before you dive in and buy. What I'm teaching you tonight are really what I call tells. That's right, they're tells. They're signals that a stock might be worth owning, that it's worth your time and effort to go through the often boring process of reading through the conference call transcripts and quarterly filings. There are thousands of stocks out there, and any method we can use to narrow down the ones that might be attractive is a method worth having. We've talked about insider buying at the high, and while I don't usually use insider buying as the only way to determine whether or not a stock has got it going or not, there's one other scenario where insider buying makes for an incredibly bullish tale. And that's when a stock has a heavy short position. Meaning a lot of people out there have borrowed shares, sold those shares, and are now waiting for the stock to go lower before they buy back the shares, return them to the bank they borrowed them from, and collect the difference between the price they sold it first and the price they bought the stock back later. Hopefully they sold it high and bought it low. You can think of shorting as like regular investing, but it's in reverse. We try to buy low and sell high, right? Shorts just turn that around. They sell high and then they try to buy low. When a stock has a lot of shorts in it, that means there are a lot of people who have serious conviction that the stock is ultimately going lower. In fact, it takes more conviction to short a stock than it does to go long. Wall Street speak for buying a stock, because when you're short, the potential downside is infinite. When you're long, a stock stops losing money at zero. Shorts lose money when stocks go higher and higher and higher. There's no lid. The other important note about short sellers is that if there's a lot of them and a stock all of a sudden gets some good news, we get what's called a short squeeze. And it sounds exactly like what it is. In order to bail or close out their positions, the shorts have to buy. This is what's called covering. When a lot of shorts cover at the same time in a panic, the stock will surge, because what you really have is a lot of people desperate to buy the stock, a lot of demand. They have to buy unless they want their years wiped out, as so many short sellers had in the last few swoons when the market refused to quit and then went right back up and the shorts hadn't covered or bought the shorts. They hadn't brought them in. So where does insider buying fit into the short selling equation? Okay, you have a stock with a high short interest. That's a sign that much of the float is sold short. Then some of the people who run the company start buying shares for themselves. Or an outsider like Coca-Cola with a Keurig Green Mountain and Monster Beverage. Sanofi with Regeneron takes more than a 10% stake, indicates it wants more. Those were three situations where the shorts kept shorting and they got crushed. They should have done buy, not shorting. It's almost like drawing a line in the sand for the shorts. They say our stock goes this low and no lower. This is an explosive combination of that kind of insider buying and a stock that is heavily shorted, one that often leads to a short squeeze that sends the stocks much higher. Shorts are smart. In fact, a lot of the time, they tend to be real smart, much smarter for the most part, I have found, than what we call long side investors. But they usually don't know more about a business than the insiders who run it. If a lot of people are shorting a stock and management is in buying it in sizable amounts, not just in 100 shares worth, then you should start doing some homework. And usually you're going to want to side with management. And then you can ride it higher and higher and higher in true Jackie Wilson style. And I regard the Sanofi and Coca-Cola buys, particularly of the Keurig and of Monster, as being inside-like buys. The shorts panic, they push the shares higher in the desperation to cover their positions, and you make money. Similarly, when a company with a heavily shorted stock announces a gigundo buyback, bigger than any previous one, that's another line in the sand situation where management's contradicting the shorts. Companies often repurchase their own shares, and while not all buybacks are bullish, some of them are just outright waste of money. I teach you how to identify the bogus buybacks in my charitable trust bulletins at actionalertsplus.com that I issue multiple times each day. A substantial new buyback in the face of shorts is often a good reason to take a closer look at a stock. Now, a note of caution here. You have to be very careful when dealing with a company that's in the crosshairs of the shorts, especially when people are nervous and the market is in bad shape. The shorts have the ability to wreck a stock, even if the fundamentals of the underlying company are fantastic. These days, the shorts have more firepower than ever. I believe thanks in part to an SEC that now, under both Democrats and Republicans, looks the other way when shorts raid stocks with bogus stories about accounting issue and management blunders. Plus, it's pretty easy to do as a stock owner. Stock owners no longer have the benefit of rules that slowed short selling down and made it harder to create bear raids. Rules like waiting for what was known as an uptick or a higher price before you could sell short stock. That was a good rule that somehow the government got talked into abolishing in order to make trading quicker and more fair for the shorts. A lot of good that did for us. It's a leading reason why so many home gamers have left the building. We established these rules in order to stop the fomenting of panic, something that happened during the Great Depression. But the government, in all of its wisdom, seems to think that panics are no longer possible. So we have to be more careful than ever not to succumb to panic. That's been orchestrated by short sellers who need prices to go lower. Without those protections, the shorts were able to run wild and practically assassinate the stocks of many financial companies during the crash of 2008 until the generational bottom in March of 2009 put the bulls back in control. But the shorts came back with aggressive negativity in and again after many of the big runs in the last few years, this time using weapons of mass destruction like double and triple ETFs. So when you're dealing with a heavily shorted stock that's in one of those ETFs like the financials, you have to learn to tread carefully. You can still find great opportunities in stocks where the shorts have overreached and the insiders are buying. But before going into one of these situations, I have to warn you that the balance of power has shifted in recent years in favor of the shorts against regular individual investors. That means even if the short sellers are wrong short-term about a company's prospects or even long-term, they can still demolish the stock, especially if they mount campaigns against the stock, like with Herbalife and Bill Ackman, the hedge fund manager who has taken on the company, even if it has been buying back stock and smart managers are on the other side of it. Just don't underestimate the amount of damage the shorts can do. Although, remember, the best protection against these raids is offered from stocks that pay good, solid dividends. Short sellers have to borrow stock to short the stock, and that means they have to pay the dividends to the real owners. That's a terrific deterrent from those who are pernicious in the way they go about shorting. When you see a stock with a big dividend that's being attacked by shorts and the dividend's going higher, oh, what a terrific place to be, especially if the insiders are snapping up stocks too. That would be thrice blessed. Bottom line, insider buying plus heavy short interest can equal raging buy as long as you avoid situations where the shorts are determined to crush the stock at any cost. Think Herbalife. Speaking of Herbalife, let's go to Herb in Florida. Herb!
Jim, great to talk to you. I'm an Action Alerts follower for the past few years. I wish I had gotten on board a lot sooner.
You're very kind. Some tough days. I like that, though, that you support us. Thank you. What's going on?
Well, I'm recently retired. I've saved up well over my lifetime, and I've looked at what the longevity of my savings, and as long as I manage things well, I'm in good shape.
Good.
My concern right now is in allocation. I have about 65% right now allocated in stocks, split about halfway between what I follow you with and the other half in index funds.
Okay.
And then the remainder is split between bond funds and cash. And, the cash fluctuates up and down between...
Sure. You're doing exactly right, just like we teach in Action Alerts.
Well, I've been paying attention then.
Thank you.
Thank you.
Well, you've got it dead right. You're doing exactly what I like. I have no criticisms. If anything, I just totally endorse that. All right. Trying to spot a raging buy? Here's a tip. When you see insider buying plus heavy short interest and then a buyback and a dividend, wow, you got something. Just be careful to avoid situations where the shorts are simply determined, no matter what, to crush not just the stock, but the business itself. Stick with Cramer. I know the rap with me, at least among my critics. It's that I'm all about trading. That I don't have any advice that's worthwhile for regular investors, that I'm all short-term. That's entirely untrue. This show has adjusted over time. It's morphed, so to speak. It's really about longer-term investing, not trading. And if you watch it any time in the last 5 years, you know that. However, knowing how to trade certainly can make you a better investor. And trading around the core position is one of the most basic and useful disciplines out there. Many people have asked me, Jim Cramer, about Twitter. What do I mean by it? Well, in markets like this one, there are periodic swoons after very big concerted runs like we've had since the bottom, generation bottom 2009. It does help to trade around. What's it mean to trade around a core position? Let's go through it step by step. First, you need a stock. Pick one that you like, one that you've got an opinion on, one where you have a bias, one that you really want to buy as it goes down. Finding a stock that you believe will be going higher over the long term is what matters, even as you accept the fact it could go down in the near term. What you're really looking for here is a great company with a stock that could get tossed around by market volatility, but that you ultimately believe will get higher if you're patient. So if you were just investing, then you'd set up a position in the stock. Buying in increments, because we all know that buying all at once is arrogance, and that's not going to be allowed in Mad Money. So why don't we use Google as an example, because I like that stock very much, have since it came public. Although only over the long term will I tell you that I like it, because it's very volatile short term and given to quick pitfalls and decline. So let's say you want to own 100 shares of Google over time. Then the way to set up that position would be to buy 25 shares 4 times over a period of weeks. Yeah, or even months. That would be your core position as an investor. Let's say you want to trade. I know many of you want to, but you feel discouraged because you remember how all that amateur day traders, remember all those day traders, they got blown out when the tech bubble burst? The key word was amateur. You home gamers can make money trading if you do it right, like a professional. In the old days when commissions were higher, that wasn't true. The commissions would eat into your profits and it just wasn't worthwhile to trade. That hasn't been the case for ages. So let's come back to our core long-term position strategy. We own 100 shares of Google and we want to own it long-term. Let's say it's trading at $500 a share for the purposes of this show. Every time the stock jumps 25 points or 5%, if you want to trade around position to preserve capital, you might want to sell 25 shares. You shave a little off to bring in some profits. So once Google reaches 525, you would own 75 shares. You keep scaling out the same way, although always, I love the stock. I would like to keep that last 25 shares. Then you wait until something happens to knock the stock down to where you bought it, as long as the news isn't specific to Google, thereby damaging Google's prospects. It shouldn't be unreasonable given that we're in a world where stocks can get crushed by all kinds of factors that have nothing to do with the fundamentals, right? As the stock comes down, you buy it back in increments. Since we started with 100 shares, let's keep using increments of 25 to buy it back. So if Google comes back from, let's say, to 500 from 575, you buy 25 shares, then another 25 down 5%. That is if you had sold the 50, not just 25 on the way up. You can even take your winnings this way and help buy 25 more if it keeps going lower, and you only got to swell 25 before the swoon. This might appear to be small potatoes, up 5% to sell 25 shares, down where you started, buy 25 shares, and repeat the process up on the way back. But over time, your profits can add up. Remember, you don't have to do anything. You don't have to do anything. You can just hold it. That is fine with me. But people ask me what trading around a core position is, and that's what it's about. A lot of people think that trading is incredibly exciting, and it can be. But if you're good at trading around a core position, it's right to be bored. There's nothing exciting about the plan I just laid out. All you're doing is watch the stock move, trimming up or adding to your position, right? Contrary to the image of trading as something that's reckless and irresponsible, trading around a core position is really the height of prudent portfolio adjustment. Boring, by the way, is good. Exciting, save it for the stadium. Of course, this whole trading around a core position tactic works best with stocks at lower prices where you can buy more stock and have more room to buy more. But I wanted to show you that it worked even with Google with a $500 stock. Again, if you own a stock and you like it, you don't need to do anything. This is in response to many questions on Twitter and in my career about how I used to trade when I was at my hedge fund, trading around a core. Obviously, you can scale these numbers depending on how big your position is. But the basic idea is to avoid putting yourself in a spot where you have too much on the table in case the stock gets swatted down, or too little on the table to take advantage of any upside that comes your way. Trading around a core position is an important basic trading strategy that you can use, even those of you who find the notion of trading, as opposed to investing, to be abhorrent. Now, if you want to take your trading to the next level, the ultimate level, then I recommend there are 2 chapters on options and getting back to even for the strategy I used at my old hedge fund. I used to think before Options Action, the TV program, that some of this material was too sophisticated for TV. I no longer think that. And you have to be willing to put in some extra homework. But if you have the time and inclination, it's more than worth the effort. The stock I used to demonstrate, it happens to be Google. And you can see how my strategy of what I call stock replacement and getting back to even works better than with options than with the common stock. It's kind of like a cheaper and less risky way to what I call creating a Google at a more reasonable dollar amount price than it currently sells at. This stuff is hard. But I am reacting to the requests I get all the time at Jim Cramer on Twitter, as many want to know about the option strategies I favor. We can't use options for ActionAlertsPlus.com, so I'm old time on this stuff. They are all there for you to use. And by the way, if you don't understand options at all, let alone the sophisticated strategies I lay out in getting back to even, in my first handbook, Real Money, that's a compilation of what I taught people who went to work at my hedge fund. I have what an option is, bottom line. Now you know the basics of how to trade around a core position if you're so inclined. Yet another method to my madness, one that allows you to generate lots of small gains that add up over time. Don't need to do it, but now you know how. Stay with Cramer. I've got one more trick to teach you tonight, one more method to my madness, and this time I want to talk selling. Sell, sell, sell. Which, along with when you buy, what price you buy, may be the most important and definitely the most undervalued tool in your home arsenal. How do you know when to sell a hot stock? How do you get out before the party ends so that you're not one of the last people around who gets stuck cleaning up the mess? This is a question that needs to be answered because there's a lot of money to be made owning hot stocks with lots of momentum. But when you play the momentum game, you have to know when it's time to leave the table. That's what's crucial. There are always naysayers. And eventually the naysayers are almost always proven right, as sooner or later, virtually all hot stocks implode, except for the ones that over time are able to develop into multiple business streams. This topping process happened big in recent years with stocks as diverse as Chipotle and Intuitive Surgical or the cloud, e-commerce, smaller biotech stocks. They kept blowing up. But it usually occurs later rather than sooner. And all the negative talking heads who kept you out of the stock with their recklessness, disguised, of course, as prudence, actually cost you a great opportunity to make money. People shy away from these stocks because they don't know where they're going to top out. That's understandable. I'd be afraid to buy them, too, if I didn't have a discipline that let me know when to get out. Lucky for you, I do have one, and you're about to learn it. First, when I'm talking about hot stocks, I really mean hot speculative stocks, stocks of companies with low market capitalizations. Usually these stocks begin with very little research coverage from the major Wall Street brokerage houses. These names can go up for a very long time. They can catch fire and stay on fire for years without sponsorship. The key to figuring out when interest has peaked and it's time to sell is by watching the analyst coverage being rolled out. You have to use your own judgment here, but a good rule of thumb is that once one of these hot stocks gets discovered and then has at least half dozen analysts, that's right, 6 analysts covering it, then the run is going to begin to peter out, not get stronger, because it is going to be too big and too well known to continue to go up the way it has. It's the rare stock that doesn't behave this way. You can find out how many guys are on a stock by looking at it anywhere on the internet. This isn't hard to find information. It wasn't one time, not anymore. This formula has worked for me for as long as I can remember. As far as I can tell, it works because the number of analysts on a stock is a good gauge of how much awareness and interest there really is in a name. And names don't get hot followed and pushed by everybody. They get hot because they get discovered by everybody. Hot stocks get tapped out when there's nobody left to be attracted to them, when all the people who would be interested in buying them have already bought. They came out of nowhere, attracting more and more attention, more and more backers, and eventually everyone who wants a piece of the stock has a piece of it. When that happens, the run is over, people, and then you must ring the register and go home. Let me give you a great example. Hansen Natural, the old Monster beverage. That was the name it used to be before it became MNST, which was one of the hottest stocks in 2004 and hottest stock in 2005. Hottest stock for the first half of 2006. Split adjusted, Hansen went from $18 and change at the beginning of 2005 to $200 when it peaked in July of 2006. The whole way up, there were people telling you that Hansen, a beverage company that really got its momentum from its Monster energy drink, was a fad, had to dry out, had to crash. Well, it did do that. But as often is the case, it took years for the momentum to run out. Not days, not months, not weeks. Years. I called the top in Hansen back then because I know how these stocks work. It peaked in July of 2006, and this was in part because of the fact that the company did a 5-for-1 split. And even though splits aren't supposed to do anything, this encouraged people who'd been in Hansen for a long time to take something off the table. Hey, I'll sell 1 or 2 shares. But there was another reason I believed it would peak. And that was it picked up its 4th analyst on May 10th of 2006 when Goldman Sachs started covering it. You had 2 months to sell between Goldman's initiation and the stock's peak. There was still some upside left after Goldman started its coverage, but prudence dictated that we sell once the stock had 4 analysts on it. Better to clear out early with your winnings than to wait for them to fade away. And Hansen, as with pretty much all of other stocks, hot stocks started to cool off once it hit that critical mass of analyst coverage. Incredibly, after Hansen fell off the radar screen, people stopped talking about it, and analyst coverage dwindled again. The stock recharged, powered higher, and again, ultimately, Coca-Cola bought a huge stake in its equity, which sent it up even further, a stock I still like. It was an amazing renaissance. But again, it was really a testament that when analysts stop following a company or do so on a desultory basis, that the company's earnings start percolating again, as was the case with Monster, a storied Lazarus-like move can happen. It turns out that the fad drink ended up vanquishing the competition from major soda brands that failed to materialize. And ultimately, the biggest one joined it rather than keep fighting it. But again, as analyst coverage gained, the stock, there's so many analysts started covering it, the stock peaked. When they dropped it, stock bottomed. That's how it works. Let me give you the bottom line. Small, speculative, steaming hot momentum stocks are often worth owning. But you must know when to sell. And that moment comes when you see too many analysts jumping on the bandwagon. Use 4 as a good rule of thumb, letting you know when to start selling. Stay with Cramer. We got to get some of the tweets you've been sending me at Jim Cramer, #mad tweets. Here we go. Our first tweet's from @JasonInvesto, who asks, looking to use technicals more, what are some resources that you recommend for technical analysis and indicators for the novice? Okay, I get most of my technical analysis from realmoney.com, and that's one of the things that I did in Get Rich Carefully was pick the best technicians who explain what these terms mean and then show you them in action, and that's what I did in that book. Next, a tweet from @RedSquare27, #GetAPlan. If I am actively trading my Roth, should I have my money in an index fund or stocks or both? Stocks, my friend. And by the way, let's be very clear. That's not the case with 401k, which is why I like the IRA options so much more. Next at Hall G. Thol 8957 tweets. Jim, I've watched you daily for over 10 years. Daily! You are awesome. You have helped massive amounts of people. Thank you. I cannot tell you there are so many people who come up to me and they apologize that they want to tell me that they like the show. So, excuse me, Jim, I don't want to bother you, but I like the show. What? No. When you say excuse me, I usually think you're about to say, boom. No, don't excuse yourself. I am absolutely thrilled that you say you like the show. It means the world to me. I sometimes figure, what the heck do I come out here every night for, other than the fact that you like it? @ClearBaffles tweets @Obfuscate Baffle. Okay, tweets the following. Please discuss balance between adding to a position and selling your cost basis. Same apply to ETFs or cost average, #GetAPlan. I like to lower my basis by selling. What I do is as the stock goes down, I buy. And then as the stock goes up, I like to sell the higher basis or market. I run a charitable trust, so I don't have to worry about tax concerns. But I think typically what I'm just trying to do is lower my basis as an owner. Why do I want to lower my basis? Because I don't like chasing and I do like buying at a discount. And lowering my basis is the equivalent of getting a stock I like of a company at a cheaper price than I got it before. That means I'm getting a bargain if the fundamentals are still good. Next, Jadal tweets the following. @Jim Cramer has more followers than Wyoming has people. I like his stock advice better too. Wyoming has more oil than I have. Wyoming wins. @Most_Jeff asks our next question. I have a long list of research companies I'd like to invest in, but don't have money for all of them. How do I narrow my list? #GetAPlan. This is very easy. What you got to do is you got to figure out, okay, which are the best at which levels? If you like them all, try to figure out what level would be the one where you'd really want to buy something. And then stick by it. Because when stock's coming down, people run through the levels instead of to them. Stay with Cramer.